Good morning, everybody. Welcome to Wise Tech for Wise Money, the podcast where we speak with founders, operators, and market leaders about how strategy, experience, and technology come together to build stronger, more scalable businesses. I'm Gary Wayne, founder of A1 Solutions. We work with founders, leadership teams, financial and real estate businesses to improve efficiency, scale intelligently, and grow through smarter use of technology systems and AI-driven operational strategy. Today's episode is titled From Property to Portfolio Thinking, Scaling Commercial Real Estate and Business Assets in a Volatile Market. Today's conversation is about something I find increasingly relevant across all markets: the convergence between real estate, business ownership, and capital strategy. Today I'm joined by Andrew Cigna from Above All Group, operating out of Ontario, Canada. Andrew works across commercial real estate and business brokerage, sitting right at the intersection of asset acquisition, deal structuring, and long-term portfolio thinking. With that, I'd like to introduce Andrew. Andrew, it's great to have you here.
Thank you for having me. It's always a pleasure chatting with you, Gary.
Yeah, me too. So maybe we can start with a little bit of your history, your journey, how you got into commercial real estate, business brokerages, and what pulled you into this space initially.
Initially I've always been in the commercial space. We started off in restoration, doing work for developers. When a flood would happen or a fire would happen, we would go in, restore it back to pre-loss condition for that developer, so then can continue on with the execution of that build. Then we got into commercial construction. We were preferred vendors for some of the municipalities here. So we did a lot of work, a lot of concrete work. And then we also did a lot of building envelopes for the municipalities. And then got into the real estate space because we were doing the construction for investors. So we were building out units, we were doing a lot of retrofits. And I got to give my hat to my brother because my brother was the contractor, right? I was just the face. He did all the operations. And we'll tie that into later why I think that's going to be a huge benefit in the future, especially with AI coming in. But what made us stand out was our quality of workmanship and how to make sure that we're meeting our numbers. And that's when we were like, okay, well, if we're doing this for other investors, why not do it for us and us be the investor? So we made a pivot. We got into single family flips, got into conversions. And during that time period when we were making that transition, I made a phone call to one of our old clients who did property management for a large real estate investor in downtown Toronto. She's like, "Oh, I'm getting out of the business." So I said, "Look, I know all your buildings. Would your landlord be interested in me managing your properties? I know them all." One thing led to another. Had a meeting with the landlord. We took on the property management contract for 2 buildings. And then that relationship evolved into us managing approximately 200 commercial units. He was a mentor of mine that taught me almost everything to do with commercial real estate. He was actually not a real estate guy. He was just owned the most amount of real estate that I've ever actually experienced. I only managed a fraction of it. With that being said, he taught me, that got me into the commercial segment. That led into us flipping multifamily buildings. He became a partner in the property management company and became a partner in actually investing into commercial real estate. So that's kind of how I got into the commercial segment of real estate.
At what point did you start to see real estate and business assets as part of the same ecosystem?
That's actually been relatively recent. So I actually, about 2 years ago, we were brokering some commercial real estate, and people were like, "Well, why don't we take a look at the business as well? Because we have to understand the financials." So once I started evaluating it, a mentor of mine, he is a lawyer that handles M&As, and he started educating me on, look, it's the exact same thing. Just think of it as a different entity, right? Because they are assets, they're cash flow generating, they have liabilities, they have cash flow. So it's very much the same thing, just different title, different structure. Once you realize that and how to place debt for a business, it is a mirroring image, just a different face.
But what's the difference in raising debt for a property as opposed to a business? Is one
Well,
easier
one's
than the other?
Yeah, so real estate's always going to be easier in my experience. Like I've raised approximately $6 million for real estate, and it's very easy because there's a tangible property that is can be secured against. So if I go, I need to raise $1 million for this acquisition, they can go, okay, well, let me see the property. We want to secure it. They secure it against the equity or what's the balance of the debt. They depend on how you want to raise the capital. You could do it through debt or equity. Typically, I've raised it through equity, but now there's lenders that they are coming in as equity partners. So we're actually having conversations now because it's so complex with this type of turbulent market. We're going to traditional debt lenders and going, hey, would you guys come in with an equity position if we have a clear exit for you in a year and a half? And they're saying, yes, that's on the table, but we need a clear plan. Before that was not even talked about. So raising capital for real estate is easier than the businesses because the businesses, they need to have either good, strong receivables or assets and equipment.
If you're doing an equity deal, does that mean you have to put up less money yourself because you've actually got a 30, 40, 50%, whatever the percentage is equity partner?
Well, so it really depends on the deal. There is a lot of people that if it's healthy enough, they're okay with you coming in as an operator. So what I'm just going to tie back into the construction component and why my brother and I kind of really did very well is because our operations of real estate was so strong. Right now, what we're experiencing, at least here in the Canadian market, is that people are very weak on the operations. They're good at the financing, they're good at the spreadsheets, but they're actually not good at executing and getting the highest and best use of the asset. So the operation is so weak, and people are going, well, right now, what we need is good operators. We don't need money. Lenders are still really open and love projects. They have very little confidence in the borrower to execute the project. So right now, people are coming to me be like, "Are you interested in taking over this project as an operator?"
That's
Right?
fantastic.
So that's really where, in my opinion, is going to make people stand out because AI is now going to be able to underwrite deals from a click of a button. Right?
Sure.
Before that was the strong position in real estate. Now, in my opinion, it's going to shift to a good operator is going to be the golden goose.
So tell me about your perspective of the current Canadian market because I've spoken to a few people in Canada recently. Everyone has a different perspective, and some guys find that it's harder to find opportunity in Canada, and they go to the States because it's easier to raise money down there than it is in Canada, etc., etc. What's your perspective?
So it depends on what asset class you're looking at, and it depends on what type of strategy you're doing. The smaller stuff is not penciling out. You would have to make it a viable deal. You'd have to be above minimum 10 units, minimum. Anything lower than that, for me, it's just not worth the squeeze. The US market has always been more favorable, and that's just because of the population, right? There's more opportunity down there. Here, we're very limited. We have six major cities and they are considered mid to low population sizes compared to the US. The US is always going to be a juggernaut. We can't compete with them, but there is still deals being done here, right? REITs are still buying them. There's US firms that are coming into the Canadian market and understanding that rents are higher than the US. Now they're coming down, but there is still massive opportunity.
You've seen a lot of volatility in the global markets, interest rates, geopolitical shifts, especially with the recent war. How is that actually impacting deals on the ground?
So lenders are more conservative on lending out money. I find that their underwriting is more scrutinized, their due diligence is more scrutinized. You're seeing people very hesitant to lend out money. Now they're getting creative on being broader on offering different products, but they're very detailed on due diligence. Because of what is happening here, a lot of people are going POS. And they're like, okay, well, because we didn't do our due diligence here, 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 we're finding lenders are very aggressive on making sure that their due diligence is done to the fullest capabilities and that um, nothing can really affect their lend. Now, the global turbulence of the world right now has people very restricted. Now we also see higher gas prices. Labor's going down because we're having a job decrease. So we are seeing a lot of effects from what's going on globally.
So what in Canada, you're a huge country. Really, I mean, you've got a lot of resources. Why is it not better, more populated? Do you not take in many overseas immigrants or anything like that?
Well,
I've always wondered why Canada is not in the same growth rate as the States because the resources are as good.
see, the thing is we are, I think, top four in natural resources, but we don't actually sell them off to other nations. We reserve them for some reason. And we can get into political opinions, but in my personal opinion, I think that if we were to reposition our resources, we would be one of the strongest nations. And we've actually decreased immigration and we've lost a population of, I believe, 65,000 compared to 2 years ago. Now, I'm not an economist by any means when it comes to relations of population, but we are seeing a huge decrease in rents, and it is forecasted that it's going to keep going down. And that's strictly driven by the lack of immigration because we were bringing in 1 million people per year. That has now stopped. So now what's going to happen is rents are going to go down. And we're seeing that through the ripple effect of underwriting deals because now developers are going, well, what are we going to exit this project at? And they have no idea. So why we're not utilizing our resources and growing, I have no idea. I wish I knew.
That obviously makes the rental market and obviously property a much tighter opportunity. Um, Lending criteria, is that very strict because of this?
Yeah, so lending is really becoming more strict because people mismanage projects. What they've done from 20 to 22 or 23 is they just hoarded properties. They would buy, and then not actually execute. Lenders were just lending money because it was so cheap, and now you know they've come home to roost, and they're calling mortgages. And when they're calling mortgages, it's like, well, what's the status of these buildings? And they haven't done anything. So lenders are now going, okay, well, you guys clearly mismanaged this project. What are we going to do to get it back on track? Because they still like the projects, they just don't like the operator. So lending has now become very scrutinized. It's like not only what's your personal net worth, what's your capabilities of executing a project.
You made a point when we spoke that businesses are like a piece of property within a portfolio. Can you expand on that mindset? When someone starts thinking like that, what changes in how they operate?
Well, they open their horizon to diversifying their portfolio, right? What is everybody was so focused on real estate here for the past 5 years. And now the US is very favorable for this and they like the businesses as a portfolio. Here it didn't take very much. What we're noticing is that more and more people are going, well, what's the multiplier here? The multiplier is 2 3. It's like, well, those are great returns, and in a year, 2 to 3 years, maybe four, we can have a clear asset where we don't have any debt and we have steady cash flow, right? And what we're seeing is there's not a lot of people to take over these mom and pop operations because the kids don't want it. And we are talking even up to farms in Canada, right? Nobody wants to do that type of labor. If you go and we're going to reposition this, add technology to it, we're going to add AI to it, and we're going to grow it. Not only is it like an asset in the portfolio, it's actually going to produce more cash flow.
Do you see clients approaching deals more strategically now then?
Yeah, so they really are, and for what is happening, the buyers need to multiplier at a certain rate. Sellers are still a little bit aggressive with their list price. It's like, okay, well, how do we meet these people in the middle? So VTBs are becoming a very viable option because they need to be creative, or they keep the previous owner as part of a shareholder, a certain class of shares, pay them out with a certain exit rate, and then be like, okay, then you guys are bought out in 2 years. Right. So there's different ways to do it. We just have to get more creative on how you structure people's exits. That's how everybody wants to know is how do I get my money? Answer that question, and then usually it's pretty easy to figure out a deal.
Is it tough to answer that question?
Yes. Yes. Right
Is
now,
that
yes.
because is that just because of the environment that we're in now?
It's the environment and people haven't acclimated to it, right? So people are still like, "Oh, I want my prices from 2022." It's like that's just not going to happen. Those days are
But when you
gone
go
and
to
it's
sell, how easy is it for the ordinary guy that wants to get involved to raise money? Do credit ratings play a lot of make a lot of difference in Canada?
yeah, so I will say that raising money is more challenging now. Money is not flowing like it used to, even with interest rates at a reasonable rate. People are very nervous about lending money because they want to know how are they going to get it back. That's their first question. Um, and do they feel confident that they're going to get it back? Right. So it is more challenging. What I'm experiencing is raising capital is a challenge right now.
So with that in mind, how important is leverage and financial strategy in both worlds, i.e., business and property? Because if people are having trouble raising money, how do they leverage?
So they actually can bring in a partner that has that type of structure where they could bring in somebody that has a good personal net worth and be like, okay, well, we're going to leverage this person, bring him in as a partner, and we just really need him to sit as a shareholder, depending on how you structure the organization. But that's how you're seeing a lot of people on smaller JVs or smaller organizations. That's how they leverage it. REITs and trusts are obviously leveraging equity from other properties to purchase new assets.
Well, where do you see the biggest mistakes made? Is it overpaying, poor structure, or lack of long-term planning?
Lack of long-term planning and the lack of experience in operations of executing on real estate. That has been by far what I'm experiencing the most while I'm underwriting these deals is I've seen portfolios from multiple entities just have buildings sit for 3 or 4 years. That would crush your cash flow report. That means you're basically just paying and losing money on a month to month basis, then a year to year basis. And it's just the operations is killing the real estate market because people just hoarded real estate like it was going out of style. And that is now catching up to them.
So these hoarders obviously can't get rid of a lot of this stock, which is obviously upending the lenders. Do you have a system in Canada like we have here, where people do like lease options, as it's called? So you've got people sitting on stock, they're not using it, they actually can't sell it either, and you do an option to buy it in say 5 years' time, and then you take over the management of it. Do you do those sort of deals?
Yeah, but they're not as common as you think, right? So we structure it a little bit different. Maybe it's not lease to own. Lease to owns are very popular. They're becoming more. They're popular in the U.S. They're not as popular here in Canada. I believe that they should make a good push here because they are good options to make deals happen. They are popular in the residential sector, but not in the commercial world. I think they will make a good push. But what we're kind of doing for our entities and our offers is like, okay, well, if we create a certain class of shares with no rights, but you have a certain exit, you just take these shares, we take ownership, and then once we're done, you redeem the on the liquidity event, you redeem the share value.
Well, that's a good idea. Well, what does a typical deal look like for you today? Are you seeing more demand in commercial real estate, business acquisitions, or hybrid opportunities? Where's the
Um,
real opportunities?
so I'm seeing it more in like the industrial space. I like the industrial space. I still like the multifamily. You just need to be really tighten your pencil. That one you really need to tighten your pencil because the multifamily is not going away. It's just what do you project in 5 years? And if it's within reason, a lender will like it. If it's not within reason and you're living in La land, like the most of the investors for the past 5 years, you're never going to get lending. And that's what I talk to people first when we go look at a business or real estate. It's like, is the lender going to like this? Right? Because you can put anything on paper and it could look great to you, but if it doesn't look good to a lender, no deal's going to happen. Right? Gary, you know better than I that 99% of deals are done because of debt and the lender. If the lender doesn't like it, you're not getting anything done.
How do you source deals today? I mean, is it network driven, market led? Do you get a lot of inbound opportunities or is it outreach?
Yeah, so we are part of a lot of off market communities. With the I still like on market. I look at on market because there's some hidden gems in there, but off market is right now the lead flow that we're focusing our attention on. And we've created communities. We have about 15,000 people across different platforms that we communicate with within the commercial space, different through different asset classes. So they are just kind of, hey, take a look at this. Do you have a buyer? We need this. Like, what's your needs, wants? And that's kind of where we're dealing with the flow is because off market typically trumps the on market, but there's still hidden gems on market.
Well, is there a lot of empty commercial space in Canada?
Retail is picking up on the vacancy, right? So industrial is very low, but retail is picking up. Retail is a pretty big concern. Same with office space, but what's interesting about office space is the high end office spaces are renting. So the big corporations are taking great spaces. Now we've made back to work, which means back to office. So people are now relocating to the office. So I anticipate that to fill that gap because we were having a shortage because it was sitting empty. We are needed to do something. The municipality called everybody back to the offices, and most corporations are following. But what we're seeing is a demand for the top quality office spaces. So, in my opinion, landlords are going to need to step up their game to be within that A tier.
But what about commercial conversions? Are we seeing a
Commercial
lot
con-
of that?
Commercial conversions have always been my favorite to underwrite. What we're seeing is people buy buildings and then chop them up because we're seeing I'm sure you're seeing it where you are too is people don't want to work for other people. They want to start their own little operation, but they need some small space. That's why the co-working environment is doing so well is people chopping up spaces and then renting them out, and then you actually charge on a higher PSF, right? So they're making the landlord's making better money, so their value of their asset goes up. We're seeing that in almost every asset class.
So when it comes back to deals and the volatility we're seeing, is that causing a lot of deals to fall through? A lot of people for looking at alternative ways to get involved because they
Yeah,
can't raise the funds, etc.
Yeah, a lot of deals are following through. We are having more deals fall through than actually making the stars align on them. There is to the point, and this is unanimous compared to. I'm talking to other mortgage brokers, other brokers. They are. We get to the 1 yard line, and then something minuscule makes it all collapse. It could be the most random thing, and what we're actually seeing is being people going, "Well, you know what we're going to do is we're going to take a retainer." And typically we were commission based type of structure. We're going to take a retainer, and if the deal doesn't go through, we keep the retainer. If it goes through, we'll allocate it to the proceeds that we would get on the commission because you're just doing so much underwriting, and we want to make sure that we're utilizing and being paid for our time, right? That's what we're starting to see is in a shift where people are going, okay, I need a retainer. This is too much of deals falling through.
Do you think deals are falling through because people are wasting people's time with unrealistic expectations?
Well, what I'm seeing is that people are so over leveraged. Just they're hunting at every avenue to go raise money, either debt or equity. They're just going through different cycles. We have some borrowers that have come to me twice, and I forgot that they came to me the first time. It's like you already circled this river, buddy. So keep moving, and we don't want to be wasting our time. People are really stretched thin, and we want to make sure that we're utilizing our time and being valued for what we're doing.
In these uncertain times, do you find people are or clients are defensive or opportunist? opportunistic?
Um, I think there's a mix of both. I think the ones that have heavy liquidity, they're very much an optimist. They're going, we got it, let's go, let's hunt, right? Then we also have the clients that are, they're over leveraged and they're like, oh yeah, we can get it. It's like they're not as optimistic, but they're hopeful. And it's just like, I don't know if I can stretch this any further, right? You kick the can down the road and there's no more road.
Is it a buyer's market or seller's market or just transitional? Or is it just a cash buyer's market?
Cash buyer's market.
Really?
It's if you have liquidity, you could win in this market, no problem. Right? That's why you're seeing REITs really do well because there's a couple of REITs here in Canada that are just gobbling up everything.
And are you seeing a lot of outside investment, like people from the States investing in Canada?
Yeah, so but we've also experienced them exiting out of the Canadian market. So we've seen a few come into the Canadian market, but we've also seen them exit out of the Canadian market. We had a building that was for sale. We had the deal lined up. The deal didn't go through, but their strategy was like, we have to leave. This is not our strong suit. This is not where we feel comfortable. We're not hitting the returns that we do in the US. They tried it on two different projects. They didn't hit the targets, either of them. And they're like, we're done here. So, uh,
Yeah, go on, Andrew. Sorry.
yeah, so they are entering, but they are also vacating as well.
I talked to a few other people in Canada, and they said there's a big push on social housing. Are you seeing that as a big, a big opportunity within the market?
I can't speak to that because I haven't experienced it, but what I have experienced is student rentals have always been big, except this year because they stopped the student visas. But I think once they start that back up, and the reason I think that student housing is huge is because you charge more on a per square footage basis because you're charging room by room. Social housing, I don't have very much experience on. I haven't underwrote those deals, so I'm not familiar with.
Do you have things like we call them HMOs in the UK, homes of multiple occupation? So you get a house or a hotel, and people convert it into a multi-room, rental for students or professionals. Is that something
Yes.
that goes on in
So
Canada?
yeah, so it's actually we have had probably a few handfuls of people do that. It is very challenging to convert it, where it increases the capex. So a lot of investors are like, "Ugh, I don't want to touch that." I think it's a great avenue to focus on the housing demand that we need. If they just removed a lot of the red tape to do that, I think that it would satisfy a lot of our demand for housing. But we haven't gone fully into it and jumped 2 feet in as a nation. I think it's on the horizon, if you want my personal opinion, because out of my network, I only know of one investor who did it successfully, and it took them approximately a year and a half just to do the zoning change and get the permit, which is quite long.
Long lead. I
Yeah.
mean, in the UK, there's a lot of it goes on. It's one of the biggest acquisition and investment portals now in the housing.
Really?
And in commercial in the UK, it's all about conversions because we've got so much empty space.
Yeah.
Because people used to, unlike Canada maybe, in the UK, people haven't all gone back to work. There's a lot of people that have gone more probably with American companies and companies like that, but a lot of UK type companies are still like allowing hybrid work. Um, people are working like 4 days a week at home, 1 day in the office. So that's led to a lot of commercial conversion. Not only conversion to office space, but conversion into flats and units where people want to live.
Yeah. I think that's needed. I think it's a great strategy. I think it satisfies one in filling the empty spaces, and it fixes a housing situation because housing is extremely expensive here, and that's just because we don't have enough inventory. So if satisfying two situations, I'm not sure why they have so much red tape around it, but I think that would be a great solution for a couple of our issues.
A lot of businesses fail on operations or they come into problems in operations. How do you find business today and what are their biggest bottlenecks and how much time is tied up just dealing with operations and the backup space?
So right now, the biggest problem with operations is finding talented labor. A lot of the businesses that I'm underwriting and have listed for sale is they're owner operated. They're either one of the top managers or they're heavily involved. And they just need to get out, and they're having a problem with the labor portion. So we're having very detailed conversations on, well, what can we offset to AI? Right? AI is making a big push on a day by day basis. You know that better than I do. And it's like, okay, well, how do we structure this where, yeah, okay, I know you want to sell it now, but if we can reposition some of these roles to be taken over by AI, can we position the company to be in a healthier position where someone that buys businesses just to add to a portfolio would entertain it? Because when we list a business, it's like, is it the owner operator pool that we're going to try to sell to, or guys who just buy businesses and put it in their portfolio? And if it's owner operated already, most guys that have it as a portfolio don't really entertain it. Or they do what we're doing and going, hey, how can we implement technology to remove the owner's work?
So is there a lot of management buyouts? The second line of management, the owner wants to sell and he's got a team under him and they buy out the company. Does that happen very often?
I haven't experienced it. That just hasn't been my strategy. We're looking at clear buyouts right at the moment. That's majority of what I'm seeing.
Do you see in Canada leverage buyouts, or is it all 30-40% down? You raise the rest of the capital.
So we're actually dealing with the 30-40%. And it's interesting that you brought that up. I was on a webinar yesterday with an alternative lender that is trying to fill that gap and then place it as debt. So they're repositioning it in a certain way. And this is going back to lenders getting creative to make deals happen, because I'm assuming they're not earning as much because deals aren't flowing. So they're coming up with alternative lending. Now, I don't have the specs for it, but they're going, well, not only are we going to look at the assets to secure it, but what's the receivables? What's the turnaround time for receivables? Like what can we leverage to satisfy a lender to give out debt to make these deals happen? So it's actually interesting that you brought that up, because lenders are getting creative in that sense. Now, I don't have the specs for the product, so I can't speak to it entirely, but I do know that they are starting to adapt to those type of conditions.
Because in the 80s and 90s and early 2000s, you might be too young to remember all that. LBOs were obviously a massive thing. Then, I would say 2008 financial crisis happened. And since then, really, they've been mostly off the table, apart from, small and medium-sized investors who put it together themselves. So I just wonder, why it's suddenly reoccurring. But it could be, as you say, because there's a lack of opportunity out there, and people have to be more creative.
Yeah, and it all stems from the lenders, and the lenders. I was just on a conference call yesterday, so we haven't gotten the full product specs, but they are coming up with new creative ways, and I'm anticipating that it's going to roll out aggressively in the third or fourth quarter, because deals aren't happening. Lenders need to lend. That's how they make money, right? So if they're not lending, they're not making money. They're not hitting their targets. So I'm very interested to see how these lenders come to light, create these products so we can see more deals, because it is a ripple effect, right? The lenders create these products, more deals happen, more people make money, and buyers buy, sellers sell.
Yeah, I mean, I love creative finance. Many moons ago, without boring you, I'm talking about 15 years ago, I bought a holiday park in the UK using my own creative finance. I went on a webinar which was about LBO, but I ended up buying this holiday park for £1.
Yeah.
I mean, I did raise a lot of debt around it, but actually on completion, I gave £1. It's quite interesting. When we go back to streamlining your business and admin, deal coordination, if you could change or streamline one part of your business overnight, what would it be?
So incorporating AI at a faster rate. We are incorporating it. AI is really getting aggressive, and I'm preaching it to my clients, And it's like, okay, well, I got to implement it too because I got to practice what I preach. I wish I could do it at a faster rate. If that was one thing that I could do for my business, is incorporate it where it's almost hands off. Because as you're aware, there's almost nothing AI can do um, that can't be offloaded or delegated to them. Incorporating those systems and policies needs to be executed at a fast rate because that will make you stand out compared to everybody else because it's going to happen. This is not like is it a fad or not? It's going to happen. And if you're the last one to incorporate it, you're going to be the last one to the party. So, in my opinion, that would be the big thing for me to incorporate for my business is the incorporation of policy for AI.
Yeah, I agree with you. I mean, obviously that's what I do, and people talk about AI as ChatGDP, Claude, the agents. But the reality is that is Google on steroids. It's not really AI. What we look to do and what people should need, and you've hit the nail on the head, is they need a systemized process that automates all your main functions. And that leaves you with more manual hours and more day hours in the day and more time to get on and grow your business.
Yeah.
So it's interesting to know. Do you think the industry is behind, massively behind, on
Yes.
automation systems?
Yes, I do. Especially where I'm sitting. I do not, from the conversations that I'm having with other brokers, they are just scratching the surface. And I feel like I'm light years ahead of them. And I feel like I'm super behind. Um, there was a study that was done is like 1% is only operates with AI, doesn't even implement it. So imagine who's just implementing it. The problem that I kind of foresee is that there's going to be a huge shift to be like incorporate AI. And then people are going to be like, well, there's no authenticity to this company, right? So like if you even look at like social media platforms, you're looking now, every post is an AI generated post or some fake post. It's like now this has become boring. But you see somebody that's actually authentic video or did it themselves, and you're like, oh, okay, I'm gonna actually retain what they're saying. Because what I'm seeing, you know this better than I, is the big dash mark. When you see a report with a big dash mark everywhere, that's like, okay, this is clearly done with AI. They didn't put the process in the final edit with a human touch. That's why I also think back to what we were talking about before the podcast is the whining and dining is going to be even more important because face to face is becoming so scarce that it needs to be done even more because we're incorporating computers and everything to do the back end stuff. Our face needs to be at the forefront the most.
I agree with you what you say about Instagram and all the postings, and however, you don't just, in my experience, just do use AI to automate something and not have human intervention. I think it takes the heavy lifting away, but I think your personality still comes out of it if you use it properly because you've got to double check everything it's done. You have to double check it because it will make mistakes. And that is where your input comes in. What it just does is speeds up how you want to express yourself if it's
Yeah.
used properly.
Yeah. Well, and that's the thing is if they do that, right? Some people don't even do the final edits. When you like I was reading some reports from a company and it's like this wasn't even scrutinized. It was just a prompt was entered, they generated this report and you guys sent this off. This wasn't edited, this wasn't reviewed by a human. Basically, they entered a prompt and then they sent it out. And that's where it's like you're either going to succeed with AI or you're not because the people that implement it and just kind of leave it to do its own thing, people are going to know. Like people are going to recognize it because it's going to become human nature for us to be like, okay, this is all AI generated. There's no human touch here. There's no human review. This is basically just scraping with LLMs to see what you can get. But the people that do it effectively, like you said, will shine here. And they'll also use their human touch and their charisma for their posts, right? So we're seeing it with a lot of brokers. They'll use AI generated of themselves. It's like, guys, people want to see the ums and the ahs now, right?
Yeah.
It doesn't, people don't want perfection.
And I think, look, I do a lot of reports and I do use AI. Of course, I'd be stupid not to. I can get something done in probably 2 or 3 days that would take me a month.
Oh
You
yeah.
know, that's a fact. But I have to read through it in detail. I have to change it. I have to keep changing bits of it. I have to correct it. You know, because I've got the experience. AI
Yeah.
hasn't.
And that's the thing that is going to make guys like you shine compared to a competitor, is because you are taking the time and effort to go through those reports and edit them, because they're not always correct.
Yeah,
Actually, majority of the time they're not correct. Now they build the framework that is great. Within minutes they can do it for you, but if the information within that framework is incorrect, you're still wrong.
yeah, definitely. And you got, you know, experience is key. You
Yeah,
know, and that's
exactly.
why I think, you know, people that work with AI will thrive. The people who don't work with it won't. But the people that use it as a tool to expedite what they're doing will do great because that's what your new skill set is.
Exactly. It's a tool, like you said, it's a tool. It shouldn't be the leader of your company.
No, it's a tool. It's a tool. Let's touch briefly on commercials. How do
Yep.
you charge or typically structure a deal? Is it primarily, and obviously it will change on the type of deal you're doing, but is it sort of commission based, success driven, profit margin based, hybrid model? Tell me roughly how you view them.
So it's typically a percentage and it's commission based, but some of the debt now that we're underwriting, we are taking retainers, and it's still commission base. But when we take the retainer, if the deal falls apart, we keep the retainer. If it's not, then it's allocated to our commission that we get for the success of the deal. Right, I've always done that type of structure. That's what I was taught, that's how I was trained, that's what I feel most comfortable with. And what I'm actually doing with a couple clients is more on a consulting basis. It's like, okay guys, you don't need a broker because we're doing a creative deal, but what I'll do is I'll charge you as a consultant. Right, we'll do, this is roughly what it would be, here's a percentage, and we hit milestones. That's very rare, but it still is starting to happen a bit more, because people just need a little bit of guidance. They don't need an actual broker. With brokering, I still do it the tried and true way, a percentage of the deal if it succeeds. But now we're taking a retainer, especially on the debt side.
Generally in business, I mean, in Canada, and I come from the financial market, so you know it's always been a way that I've lived. But do people generally believe in you eat what you kill?
Yes, yes. And that's becoming harder now, because to kill is, it's like they took your weapon away because the economy is not that strong. So it's like, okay, the kill is harder to do. Um, but that's the typical way here, and that I don't see that changing anytime soon.
Do you think traditional fee structures are outdated? I mean, how do you see the model evolving over the next few years, or is it really going to be dictated to by the economy?
It's going to be dictated by the economy. Everything's usually dictated by the economy, right? What I like to do is I like to work with guys that have been through three or four of these type of turbulent markets, because they know it's like, okay, just ride it out, right? The younger guys, they always want to be like, oh, I don't need guidance. Even when you're like, I'm in the middle tier, so I'm not young, but I'm not as experienced as the guys in their 50s and 60s. I want to go and hang out with the guys in the 50s and 60s, because they've been through more ups and downs than anybody, and they'll know, like, okay, when this happens, this is what we do. When this happens, this is what we do.
If we read and look at social media, we believe, you believe everything moves in a straight line.
Yeah.
Yeah, being one of those guys in his 50s and 60s, whatever, I can tell you there's no such thing as a straight line. You
No.
get rich, you get poor, you get rich, you get poor, you know, and you rebuild because that's what markets are about. That's what they do.
Yeah, exactly. Like we were very successful in what we did, but the year after we took a real good kicking. It's, and it wasn't that we lost on a project. It was just something that came up and we made the wrong move. It was more of a marketing move, and it just didn't work out. And that's where you lost. I didn't lose on the project, but I lost on the strategy to try to execute on a project. So You take a loss, but you keep moving. As long as your average is above normal, then you're winning, in my opinion. But everybody thinks they're going to bat 1,000. If you're thinking of doing that in the investing world, then you might as well get out of it and go work for somebody else because you don't bat 1,000.
People aren't born lucky; they make their luck. I do believe in
Y-
that. And
Exactly.
to be successful in business, you need to be resilient, thick-skinned, and you need to keep pushing.
Exactly. Right. Like you do
Looking
really make
ahead,
your own
where do
luck.
you see the biggest opportunities for business for your business now?
For my business now is I'm going to see that a lot of sellers of businesses want to exit out because they've reached an age, they don't have children that want to take over. I do think that that is going to be one of the biggest opportunities for brokers and investors is real estate. We can only develop so much. Do have a lot of red tape here, but businesses, there's a great volume of them, and a lot of them will be exiting it out in the next 5 to 10 years. And I think that's where a great opportunity is for people to add to their portfolio and use those assets to generate cash flow.
And what's your plan when you buy these companies? If you buy 5 or 10, do you look to take them public, or do you keep them private and just you know formulate a conglomeration as such?
I like the private sector. I've never really dabbled in the public. I have a buddy who's really kind of in that and he's really pushing hard for it. But I stay private. I like a private life. I like private companies. It's just easier to manage. My buddy, he is more of he's pushing to the public and it's just not for me.
I think the public obviously comes with a lot more regulation. I
Yeah.
think the only good thing about being public, because you get too much scrutiny, but the only good thing about being public is you can get access to big pots of money, where
Yes.
as private is a little bit more difficult. But I think we've seen less IPOs globally over the last 5 to 10 years, especially since, and probably over the last 26 years. It's been in decline since the dot com boom busted, simply because the regulations got tighter and tighter and tighter, and the people in public companies just can't move.
Yeah. And what I've seen just from reading some articles is that more and more public companies are turning private, which was before it was the other way around. Now I'm witnessing the REITs that are public, they're like, "Oh, we're going private. We're going private." Before it was like, "We want to push the public. We want to push the public," because like you said, the opportunity of getting more money is there. But at some point, it's like, okay, well, we don't need more money. We need to manage these assets properly. Private is the better way because we're not under a microscope. Sometimes operating under a microscope is very challenging.
Yeah, very difficult. Do you see yourself staying focused locally or expanding geographically?
Expanding geographically. I really like the US market. I have some corporations already established in the US. I haven't executed on anything just because of some home life stuff. I just had a beautiful little girl. So I'm really kind of focusing on here. But I do have things set up to do the US. I do like the US market. I think there's a lot of opportunity. I think debt is very favorable there. Here, it's not as favorable. I think it's going to come here, but it's not there yet.
I think the UK and Canada need to upgrade their focus really. In the States, from what I see and understand, I look at all the markets. As long as the deal flows and it works, cash flow wise and everything, you'll get money. Whereas in the UK specifically, and I understand a little bit more in Canada, that's not always a criteria,
Yeah,
and a lot of deals get squashed because of it.
exactly. They go off ratios here. Sometimes the ratios are absurd. Um, the U.S. as long as it makes money and they can have a clear exit, people will put debt to it. Here, it goes off ratios and risk, and it's too aggressive. I understand that they should consider it. I can appreciate that, but it's a little too aggressive because they're conservative.
Well, I think sometimes because as interest rates go up and the ratios change, they become too tight to allow a deal to work, even though you can make it cash flow.
Yeah, exactly.
Okay, I'm just in finalising. I mean, I might have asked this question to you in a roundabout way earlier, but if you had a magic wand and you could fix one thing in your business instantly or in your market, what would you do?
So to just circle back on what I would fix in my business and incorporating AI as fast as possible, faster than what I'm doing, and I feel like it's fast. just not fast enough. If I were to able to wave a magic wand for our market, I would ask for the lenders to focus even more on operators compared to people with high net worth. Just because somebody is has a good net worth doesn't mean they can execute on real estate. Because that's where we're seeing a lot of things fail. Is people because they have a good net worth doesn't mean they can execute on a project very well. Operators are key. Some lenders are really starting to focus on that. I wish almost all of them did because operators understand how the building works, how to get it up and to that best use as fast as possible. These guys can get it to where it needs to go to the fastest point. Sometimes the guys with the net worth, they're focused more on budgets and spreadsheets and not actually on the operations of getting the building executed.
Great, Andrew. Thank you very much for your time. I hope you've enjoyed the podcast.
I have, I
For,
have.
I try to ask a lot of questions. I'm interested in all this stuff myself, so it's easy, for me to do this. For anyone listening who's interested in what you do and the real estate business, business acquisitions, building a portfolio, what piece of advice would you give them right now?
Know your numbers. Know your numbers to the greatest detail, because the lenders know their numbers, and we're going to need to have open dialogue with them. Even for sellers, like they need to know their numbers because buyers know what they're looking for because becoming more experienced with the implementation of AI, it's easy to incorporate for somebody to do a review. Knowing the numbers is extremely important.
So, if people want to talk to you, where can they find you?
They can hit me up at Andrew at theaboveallgroup.com, or they can hit me up on LinkedIn at Andrew J. Cigna.
All right, great, Andrew. Well, thanks very much. I want to thank everybody for listening in. We'll be back in another couple of days with another episode of Wise Tech for Wise Money. It's been really insightful having Andrew on this program. I want to thank you again, Andrew, and I look forward to talking to you soon. Thanks very
Awesome.
much, everybody.
Thanks for having me.
Welcome. It's been a great, great podcast. Thank you.